Ever stared at your trading screen wondering, why your carefully planned moves just aren't panning out, like you're following a map that's constantly changing?
Yeah, that frustration is incredibly common. And, well, often it boils down to really understanding the fundamental landscape you're operating in. Is the market generally heading up, down, or just kind of moving sideways?
Exactly. So today, we're going to try and cut through some of that confusion.
Hmm.
Our mission really is to give you some clear, actionable ways to identify whether we're in a bull market, a bear market, or maybe a neutral phase.
Think of it like getting a reliable compass for the market.
Yeah, a compass. Good one.
And our source for this deep dive is an excellent YouTube video from WiseTrade. It's called Bull Market vs. Bear Market, the reason you're losing money. They lay out a really practical framework.
Right. And over our time together, we'll be pulling out the key insights on how to spot these trends just by, looking at price action, those
Yeah.
waves, the ups and downs on a chart.
Mm.
We'll decode consolidation patterns, those little pauses that can tell you a lot. Plus, we'll look at the story told by engulfing candles, trend lines, even how a simple moving average can offer clues.
And we'll touch on neutral markets too, the sideways stuff.
Absolutely. Ready to get started?
Let's do it. Let's jump right into bull markets first.
Okay. Bull markets.
So, at its heart, a bull market is basically a sustained period of upward price movement. Now, people often define it technically like a 20% or more rise in a major stock index.
Right. You hear that number thrown around.
Yeah, but it's really more about the overall feeling too. Optimism, confidence, and just fundamentally more buyers wanting in than sellers looking to get out.
The video uses a pretty helpful image here, doesn't it?
Mm.
Comparing market momentum to like a strong river current.
That's right. The idea is even if your timing isn't perfect, being in sync with that powerful upward flow of a bull market, it can definitely tilt the odds in your favor.
It's like going with the flow, literally. Easier than swimming upstream.
Exactly. And one of the most fundamental ways to see this upward flow is by looking at the sequence of swing highs and swing lows on the chart.
Okay, let's break that down a bit. Swing highs and swing lows. What are we looking at exactly?
Well, a swing high is essentially the peak price reached before the price dips down again.
The top of a little wave.
Right. And a swing low is a bottom of that dip, the lowest point before the price starts climbing back up.
Got it.
So what you typically see in a real bull market is a pattern of higher highs, meaning each new peak is higher than the last one,
Okay.
and higher lows, meaning each dip, each swing low, doesn't fall as far as the previous one. It keeps making higher bottoms.
So it's like a staircase climbing upwards. Step up, small step back, bigger step up.
Precisely. It's a very visual indicator that buyers are consistently pushing the price to new heights after each, let's say, temporary pullback.
So if you spot this consistent stair-stepping upwards on a chart, the video suggests your trading focus should probably lean towards going long, betting on the price to keep rising.
Generally, yes, especially looking for entries when the price dips back towards potential support levels within that uptrend.
Makes sense. Go with the current.
Exactly.
Hmm.
Now, another signal that often suggests a bull market is likely to continue is the formation of what we call consolidation patterns.
Consolidation. Like the market's pausing.
Yeah, think of them as moments where the market just moves sideways for a bit within
Yeah.
that bigger uptrend. They can sometimes look like, little rectangles or triangles forming on the chart.
Right, like it's catching its breath before the next move up.
Yeah.
So what's the key thing to watch with these pauses?
The crucial part is what happens after the consolidation. If the price breaks above the upper edge of that pattern, that often signals that the buying interest is heating up again.
The breakout.
Yes, the breakout. It suggests the bull market is poised for another move upwards. It kind of indicates new buyers are stepping in, pushing prices to higher levels.
Okay, so consolidation during an uptrend, followed by an upward breakout that's a bullish sign. Got it. Now, the video also talks about massive bullish engulfing candles. That
Mhm.
sounds pretty dramatic.
It can be a strong visual cue, yeah. A bullish engulfing candle is basically when a green candle, a positive candle, is noticeably larger and completely wraps around or engulfs the previous red or bearish candle.
Okay, so the green one totally covers the red one before it.
Right. And when it's described as massive, it just means it's significantly bigger than the candles around it. It really stands out.
And what does it tell us when we see these big green candles popping up fairly often during an uptrend?
It suggests strong, sustained buying pressure. It's like a visual representation of buyers really overpowering the sellers at that moment.
Yeah.
It reinforces the idea that the bull market has strength and is, likely to continue its upward path.
Okay, visually powerful. Makes sense. Or what's another tool in our kit for spotting these bull runs? Trend lines, I think.
Yes, trend lines. Classic, but still very useful. In a bull market, you can typically draw an upward sleeping line that connects a series of those swing lows we talked about earlier.
So you're basically drawing a line underneath the rising price action, kind of touching those bottom points of the pullback.
Exactly. You're connecting the dots of the higher lows. This trend line acts as a visual confirmation of the uptrend. As long as the price respects this line, bounces off it.
It holds as support.
Right. It suggests that the underlying buying interest remains strong and the bull market is intact. It can even offer potential entry points for buying opportunities when the price comes back down to touch that trend line.
Okay, so we've got higher highs and lows, breakouts from consolidations, these big bullish candles, and a solid upward trend line. We're building a good picture here. The last method mentioned for identifying a bull market was using moving averages. Can you expand on that?
Sure, moving averages, well, they help smooth out the price fluctuations over a specific period, right? Gives you a clearer view of the underlying trend direction.
Kind of filters out the noise.
Yeah, exactly. The video specifically highlights the 50-day exponential moving average, the 50 EMA, as a useful example. But it's worth noting, traders use all sorts of different lengths, 20, 100, 200 day.
Right, different time frames. But focusing on the 50 DMA, what does it typically tell us in a bull market?
In a healthy bull market, you'll generally see the price consistently staying above this moving average. The video makes an important point here. The price shouldn't be constantly chopping back and forth through the moving average.
So not weaving through it, but staying clearly above it.
Correct. If it remains comfortably above it, that's another indication of sustained upward momentum, another check mark for the bull case.
Okay, price action consistently above the 50 EMA.
Yeah.
Got it. Now, this is crucial too. Just as important as spotting a bull market is recognizing when it might be running out of steam, right? What are some signs that a bull market might be ending?
Absolutely critical. Recognizing potential turning points lets you protect your gains, maybe even prepare for a shift in direction. The video outlines several key warning signals to watch for.
All right, let's walk through them. The first one mentioned is a lower high. Now, we just said higher highs are key for a bull market. So what's the big deal about seeing a lower high?
Well, a lower high is often the first hint that the buying pressure might be weakening. Think about it. The price tried to go up again, but it couldn't even reach the previous peak.
It failed to make a new high.
Exactly. Even if the price makes another low afterwards that's still higher than the last low, that failure to reach a new peak suggests a potential shift. The upward thrust is losing some of its power.
Okay, so that's the first yellow flag. And closely following that, the formation of a lower low. How does that strengthen the case for the end of the bull run?
Right, so if you see that lower high and then the price drops and makes a swing low that's below the previous swing low, well, that's a more significant signal.
Because it breaks the pattern.
It breaks the pattern.
Mm.
The sequence of higher highs and higher lows is officially broken. That's a strong suggestion that a downtrend could be starting.
Okay, sequence broken, lower highs and lower low. Got it. What about those consolidation patterns we discussed? Can they also signal the end?
Yes, they absolutely can. If a consolidation pattern forms after a good long uptrend and then the price breaks below the lower boundary of that pattern.
Breaks down instead of up.
Precisely. If it breaks down and creates a lower low in the process, it suggests that sellers are now gaining control and the bull market might be over. The video mentions a descending triangle as one example that pattern often forms before a downward move.
Interesting. So a consolidation after a bull run, but it breaks down warning sign.
Mm-hmm.
What about those engulfing candles, but in reverse? Massive bearish engulfing candles.
Exactly the same logic, just flipped. Just like a big bullish engulfing candle signals buying pressure, a really large bearish engulfing candle, a big red one swallowing the previous green one appearing after an uptrend suggests strong selling pressure.
So maybe buyers are locking in profits.
Could be profit-taking, could be new sellers coming in aggressively. Either way, it indicates the upward momentum is potentially reversing hard.
And what about a sudden sharp move down, a massive gap down? Does that also hint the party might be over?
Oh, yeah. A significant gap down, where the price opens way lower than where it closed the previous day, can be a powerful signal. It often reflects some overnight news or a sharp shift in sentiment, strong negative feelings, maybe even panic selling kicking in.
Right, that sudden empty space on the chart can be pretty telling. Okay, what about our friend the upward trend line from the bull market? Can a break of that line give us clues too?
Definitely. Remember that upward sloping line connecting the swing lows, acting as support.
Yeah.
If the price decisively breaks below that trend line, it clearly suggests that the underlying buying pressure isn't strong enough anymore to hold that upward angle. The support has failed.
So the floor breaks.
The floor breaks. It's a strong signal that a change in direction might be underway.
Okay, break a trend line, support another warning. And finally, what about our moving average, like the 50 EMA? Can that also signal a shift?
Yes. So if the price, after consistently riding above the 50 EMA during the bull run, then breaks cleanly below it.
Not just dipping below briefly, but a clean break.
Right, a decisive break below, and then it stays below it, starts trading below it consistently. That can be another solid indication that the bull market's upward momentum has faded. The trend might have shifted below that key average.
All right, wow, that's a lot on bull market spotting them and spotting the potential end. Okay, let's switch gears now and dive into bear markets. What's the basic definition here?
Well, unsurprisingly, a bear market is pretty much the opposite of a bull market. It's characterized by a sustained downward trend in prices.
So prices are generally falling over time.
Exactly. And again, there's that technical definition you often hear, like a 20% or more decline in a major stock index from its recent peak.
Right.
But more fundamentally, the prevailing feeling is negative. It's marked by fear, pessimism, uncertainty. And that leads to more people wanting to sell than wanting to buy.
And the video really stresses a key trading strategy difference here, doesn't it? In a bear market, the focus generally shifts to going short, betting on the price to fall further.
That's the general guidance, yeah. You want to align yourself with that dominant downward momentum. Trying to buy and hold going long in a strong bear market is usually much riskier.
Because any bounces up are often just temporary, right? Before the main downtrend resumes.
Exactly. Those are often called bear market rallies or bull traps. They can look tempting, but the bigger trend is still down.
Okay, so how do we identify a bear market using price action? Similar methods to the bull market, just flipped.
Pretty much, yes. The first method highlighted is looking for lower highs and lower lows.
Ah, the downward staircase again. Instead of climbing up, we're heading down.
Precisely. Each new peak, swing higher, is lower than the previous peak, and each new trough, swing low, is lower than the previous trough.
Consistent downward steps.
Right. This pattern clearly signals a downtrend, a bear market. And when you see this, your trading focus naturally shifts. You start looking for opportunities to take short positions, maybe when the price bounces up temporarily to a potential resistance level.
Sell the rallies, essentially.
That's the idea in a downtrend. Okay, so that's lower highs and lower lows. What about consolidation patterns in a bear market?
Do they still happen? Pauses in the downtrend.
They do. You'll often see the market move sideways for a bit, even within a strong downtrend. But the key here is what happens next.
To break out again.
Yes, but this time, if the price breaks below the lower edge of that consolidation pattern,
Weights you down further.
right, that suggests the selling pressure is picking up steam again, and the bear market is likely to continue its descent. It signals new sellers are jumping in, pushing prices even lower.
Okay, so consolidation during a downtrend, followed by a break to the downside that it's a bearish continuation signal. Makes sense. And candle patterns.
Yeah.
We had bullish engulfing, so now it's bearish engulfing.
You got it. The massive bearish engulfing candle. We touched on this when talking about the end of bull markets, but they're also a key feature within a bear market.
Remind me, big red candle swallowing the previous green one.
Exactly. A large bearish candle that's noticeably bigger and completely engulfs the prior bullish candle. When you see these forming fairly often during a downtrend, it indicates strong, persistent selling pressure.
It reinforces the bear case.
It really does. It suggests the bear market is firmly in control and likely to keep heading south.
All right, big red candles in a downtrend noted. How do trend lines help us spot and confirm these bear markets?
So just like we drew an upward trend line connecting the lows in a bull market, in a bear market, you can typically draw a downward sloping trend line connecting a series of those swing highs, the peaks in the downtrend.
Okay, so this time you're drawing a line above the falling price action, touching those peak points, the lower highs.
Precisely. This downward trend line acts as a visual confirmation of the bear market. It represents resistance.
The ceiling.
The ceiling, exactly. As long as the price respects this line, it rallies up to it and then gets rejected, bounces off it to the downside. It suggests that the selling pressure remains dominant.
And it can offer shorting opportunities near the line.
Potentially, yes. When the price touches that trend line, acting as resistance, traders might look for signs to enter short positions.
Okay, a downward trend line acting as resistance. Got it. And finally, moving averages again. How do they play into identifying a bear market, using the 50 EMA example?
So, flipping the bull market scenario, in a sustained bear market, you'll generally see the price consistently staying below the 50 EMA.
It's just hanging out underneath it.
Yeah. And again, the key is consistency. It shouldn't be constantly whipping back and forth across the line. If it's consistently trading below that moving average, it suggests continued downward momentum.
Okay, price consistently into the 50 EMA, another check mark for the bear case. Now, just like with bull markets, it's super important to know when a bear market might be ending, right? How do we spot potential bear market bottoms? When might things be turning around?
Absolutely crucial. Identifying potential reversals lets you adjust your strategy, maybe stop shorting, maybe even start looking for potential long opportunities carefully. The video highlights several signals to watch for here, too.
Okay, let's go through them. The first one mentioned is the formation of a higher low. We know lower lows define a bear market. So what does a higher low tell us?
A higher low is often the first clue that the selling pressure might be drying up. The price dipped, but it didn't go as low as the last time.
Buyers stepped in sooner.
Potentially, or sellers just weren't as aggressive. Either way, it suggests the downward force is easing. Even if the price still makes a subsequent high that's lower than the last high, that failure to make a new low is significant.
Okay, first hint of a change, and then following that, if we see a higher high forming, that would strengthen the case.
Yeah, exactly. If you observe that higher low and then the price rallies and manages to break above the previous swing high, well, now you have a higher high and a higher low.
The downward staircase pattern is broken.
It is. The bear market's pattern of lower highs and lower lows has been violated. That's a much stronger indication that a potential uptrend, maybe the start of a new bull market, could be beginning.
Okay, sequence broken again, but in the other direction. What about consolidation patterns at the end of a bear market?
Similar logic again. If a consolidation pattern forms after a sustained downtrend, and then the price breaks above the upper edge of that pattern,
Breaks out to the upside this time.
right? If it breaks above, creating a higher high in the process, it can suggest that buying pressure is returning strongly, and the bear market might finally be over. The video even mentions that same descending triangle pattern. If price breaks above it after a downtrend, that can be a bullish reversal signal.
Interesting. So the same pattern can signal continuation or reversal depending on which way it breaks.
Exactly. Context is key.
Okay, so a break above consolidation after a bear run, potentially bullish. And engulfing candles again, massive bullish engulfing candles, showing up in a downtrend.
Yes. Just like a big bearish candle is bad news for bulls, a big bullish engulfing candle appearing after a long downtrend suggests strong buying pressure is suddenly emerging.
Like the sellers are exhausted and buyers are taking over.
Could be sellers covering their shorts, could be aggressive new buyers stepping in. Whatever the reason, it visually shows a powerful shift towards buying, potentially reversing the downward momentum.
Okay, and a sudden sharp move up. A massive gap up. Can that signal the end of the bear?
It definitely can. A significant gap up, where the price opens way higher than the previous close after a downtrend, often reflects a major positive shift in sentiment or news. It indicates strong, maybe even panicked, buying interest coming in.
The opposite of the gap down signal for bull market top.
Precisely. That sudden upward jump can be a powerful sign the bear market might be finished.
And our downward trend line, the resistance line to bear market, what happens if price breaks above that?
Remember that downward sloping line connecting the swing highs, acting as the ceiling. If the price decisively breaks above that trend line, it suggests the selling pressure is no longer strong enough to keep the price down. The resistance has been broken.
The ceiling cracked.
Right. It's a clear signal that a change in direction towards a potential uptrend might be underway.
Okay, breaking above resistance, a hopeful sign. And finally, the moving average one last time. How does that signal a potential end to the bear market?
So if the price, after consistently trading below the 50 EMA during the bear market, then manages to break cleanly above it,
Gets back above the average.
yes, gets above it, and crucially, stays above it, starts trading consistently above it, that can be another strong indication that the bear market's downward momentum has finally ceased. A new, potentially bullish phase might have begun. The trend might have shifted back above that key average.
Phew. Okay, so we've covered the ins and outs of bull markets, bear markets, how to spot them, how to spot when they might be ending. It's a lot, but really useful. But the market doesn't always go straight up or straight down, does it? Sometimes it just kind of bounces around.
Exactly. It gets stuck in neutral. That's where the neutral or sideways market comes in.
Right. So what's the key characteristic here? How do we know when it's just chopping sideways?
Well, a neutral market is basically what it sounds like. Price is moving more or less horizontally. There's no clear upward or downward trend. It's often characterized by roughly similar highs and roughly similar lows.
Like it's stuck between two levels.
Pretty much. Think of it as a period of balance or maybe indecision between buyers and sellers. Neither side is really winning for a sustained period.
So the market's taking a longer pause, maybe trying to figure out its next big move. How do we identify this sideways movement clearly on a chart?
One of the main ways is seeing those easily identifiable swing highs and swing lows we talked about,
Yeah.
but they're happening at roughly the same price levels over and over.
So not higher highs and lows, not lower highs and lows, just same highs and lows.
Roughly, yeah.
Cool.
You can essentially draw a horizontal zone of resistance connecting those similar highs, like a ceiling,
Yeah.
and a horizontal zone of support connecting those similar lows, like a floor. The price action then tends to just bounce back and forth between these two levels contained within that range.
Trapped between the ceiling and the floor. Right. Got it. What about our trusty moving average, the 50 EMA, in a neutral market? What does that usually look like?
Well, since there's no clear trend, the moving average itself will also tend to flatten out and move sideways. And importantly, it often cuts right through the price action.
So it's not clearly above or below.
Exactly. The price will be weaving above and below the moving average constantly. It gets really choppy. And the MA doesn't offer a strong directional signal at all in this kind of environment.
Right. It reflects that lack of clear direction. And what's the general trading approach in a neutral market, according to the video? Can you even trade it?
You can, but it requires a different approach because the price is often reasonably well contained within that defined range.
Between the support and resistance zones.
Right. Both buying near the support zone, hoping for a bounce back up towards resistance, and selling near the resistance zone, expecting a move back down towards support can be viable strategies for some traders.
So playing the range, essentially.
Playing the range. The key is being really aware of those defined boundaries, managing risk carefully, and being very cautious about potential false breakouts, where the price briefly pokes out of the range but then snaps back in.
Right. Those can be tricky. Okay, so wrapping this all up, it sounds like really understanding whether we're in a bull, bear, or neutral market is just absolutely fundamental. It's like step one.
It really is. It's the essential context. Getting this wrong is, as the video title suggests, a big reason why many traders lose money. It should absolutely inform your trading decisions and help you avoid fighting the dominant trend.
Yeah, swimming against that current we talked about.
Exactly. And we've explored several key methods today from that Wise Trade video to help identify these market types, paying attention to the sequence of highs and lows.
Higher highs lows for bulls, lower highs lows for bears.
Right, analyzing breakouts from those consolidation patterns.
Upward breaks and uptrends, downward breaks and downtrends.
Recognizing the significance of those massive engulfing candles, using trend lines to define the direction and potential support or resistance,
Upward sloping for bulls, downward for bears.
and observing how the price relates to a key moving average, like the 50 EMA staying above it in bull markets, below it in bear markets.
And remembering that neutral markets are different again, that sideways chop within a clear range, with the moving average often cutting right through price.
And, this understanding, it really extends beyond just short-term trading decisions. Recognizing these broader market phases, are we generally in a bull or bear environment that provides super valuable context for longer-term investment decisions, too?
Yeah, and just understanding the overall economic climate, maybe.
Absolutely. It helps frame everything else.
Yeah. So now that you, listening, have these tools, these ways to analyze market direction, how might this fundamental understanding, well, influence your own financial decisions? Or even just change your perspective on the bigger economic picture you read about? It's definitely a powerful lens to look through.